Welcome back to The Explainer. Today, we are cutting through the noise to decode the actual mechanics of gross domestic product and national income accounting. We're going to transform those massive, intimidating macroeconomic figures into a clear, completely logical framework.
Think about it for a second. How do economists accurately calculate the total output of an entire nation? I mean, tracking every single transaction, from a loaf of bread at your local bakery to a manufactured car rolling off the assembly line. It requires a brilliantly structured system so we don't just get completely lost in the numbers.
To figure this out, here's our game plan. We'll trace the circular flow of income, look at 3 ways to measure GDP, walk through a real-world value-added model, untangle factor cost from market price, and finally, separate real from nominal GDP. Let's get right into it. Starting with Section 1, the circular flow of income. We're zooming all the way into the micro level first, looking at the very engine of the economy. To produce literally anything, we rely on 4 fundamental factors of production. And an easy way to remember who gets paid what is the acronym RWIP. Land earns rent, labor earns wages, capital earns interest, and entrepreneurship earns profit. Basically, profit is simply what's left over after the rent, wages, and interest have all been paid out of the revenue. These 4 pillars are the absolute foundation of all economic activity. And this sets up a continuous closed loop. It's actually pretty elegant. Households supply these factors of production to firms and get paid for them. And then they spend that exact same money buying goods right back from those same firms. Money flows one way as income, while the physical goods flow the other way as output.
Moving on to Section 2, 3 ways to measure GDP. Now we're scaling up from that single loop.
Because this system is a closed loop, we can measure this exact same macroeconomic house through 3 different windows. And get this, we get the exact same result. Whether you look at product, expenditure, or income, they all have to theoretically equal the exact same GDP number. Why? Well, because every single dollar spent on a final good is simultaneously a dollar earned by someone else in the production chain. They are just 3 different views of the exact same flow. If we take the expenditure approach, for example, we just add up the spending from 4 different buyers in the economy. C is private consumption by regular households like us. I is gross investment. That's businesses buying machinery or building factories. G is government spending on things like infrastructure and defense. And finally, we tack on X minus M, which is net exports. That's just the difference between what foreigners spend on our goods and what we spend on theirs. Add all those up and you've got the entire economy's expenditure. All right, Section 3, the value-added example. Let's see how the output method works in the real world without accidentally counting the same product twice. So, the biggest trap here is double counting. To avoid that, we have to strictly differentiate between intermediate goods and final goods. Intermediate goods are inputs bought by a firm to be transformed further, like flour bought by a bakery. Final goods, on the other hand, are totally ready for the end consumer, like the actual bread you buy at the store. To accurately measure GDP, we must only count final goods, or simply count the new value added at each step.
Let's trace a loaf of bread to see this in action. A farmer grows wheat and adds 21 cents of value. A miller buys it, grinds it into flour, adding 28 cents of new value. The baker turns it into bread, adding 43 cents. And finally, the retailer sells it, adding 8 cents of value. If we just added up every single receipt along the way, we'd literally be counting the farmer's wheat 4 different times. No way! By only adding the new income created at each step, we reach a final GDP of exactly $1. We perfectly avoid double counting the wheat.
Next up is Section 4, factor cost and market price. Time to untangle the nuances of those price tags attached to final goods. See, the base cost of production, paying for that land, labor, capital, and entrepreneurship, is called the factor cost. But when goods actually hit the retail shelves, the final market price shifts. To get from factor costs to market price, we have to add indirect taxes, like VAT or sales tax, because they raise the final price. But we also have to subtract any government subsidies, because subsidies artificially lower the final price. Understanding this bridge is absolutely key to reading national accounts accurately.
And that brings us to Section 5, Real versus Nominal GDP. Let's separate the illusion of inflation from actual, genuine economic growth.
Before we can even calculate growth, we have to distinguish between stock and flow variables. These are fundamental concepts. A stock variable is measured at a specific point in time, with no time unit attached, like the total wealth you have right now. A flow variable is measured per unit of time, like your monthly income. GDP, it's a flow. It's the output over a given year.
Picture a giant water tank to really visualize this. The amount of water already sitting inside that tank at exactly noon, that's your capital stock. It's a snapshot. Meanwhile, the liters of water pouring in through the tap every single minute represent the flow of new net investment. Both are essential, but they measure the economy in entirely different dimensions. So, when measuring the flow of GDP year after year, prices naturally rise due to inflation, right? Nominal GDP uses current year prices, which can be super deceiving. If our GDP goes up by 10%, do we actually produce 10% more, or did things just get 10% more expensive? To find our actual growth, we use a tool called the GDP deflator. It strips away price changes, revealing the real GDP based on constant base year prices. It's a real game changer because it tells us that the economy is truly expanding its output.
So, we can now calculate our national output flawlessly, making sure everything from the farmer's wheat to government spending is perfectly accounted for. But I want to leave you with a provocative thought here. When we look at alternative metrics like the Human Development Index, which factors in life expectancy and education, or the Genuine Progress Indicator, which subtracts environmental damages, we really have to ask ourselves, does this massive GDP number actually measure our true progress as a society, or does it merely measure our output? It's a fascinating question to chew on. Thanks for joining me on this explainer. Keep questioning and keep learning.